Welcome back to the Bitcoin Layer. Today we have a very special guest, Lawrence Lepard. He is the managing partner at Equity Management Associates LLC in Boston, Massachusetts. Lawrence, thanks for coming on today.
Oh, thanks for having me on, Joe. It's an honor to be on your show.
Most definitely, it's always good to have a fellow Boston guy on the show. Why don't you give our viewers an introduction of who you are? Essentially, give us some background on yourself and also why you founded EMA and what the firm is all about, what their investing strategy is.
Sure. Many people know this. I'll try not to make it too long. I'll give you the brief version. I've always been a professional investor, managing money. That's kind of what I trained to do in business school, and I've been doing it since the early 80s. So I've got a lot of experience at it. Started off in the venture capital business, and that did very well for a bunch of years. So I was really a growth and technology investor from the 80s into the mid 2000s. And then I kind of, when the dot-com bubble burst, I kind of retired or semi-retired and pivoted into managing money just on a growth at a reasonable price basis. And what really happened, the thing I guess that radicalized me was the GFC, in 2008 was just an enormous wake-up call for me. It was like, oh my goodness, I've got this capital, I've got these savings that I've built up over years, and the government could just print this stuff, and it's not gonna. We're gonna have inflation, and what I've saved isn't going to buy as much. And I'm in my early 50s, late 40s, early 50s. I got to go back to work, and I got to figure out a way to defend my capital from this government, largesse. So I pivoted and I started investing in gold and silver mining companies because at the time, as you know, the white paper was written in '08, so it really didn't have any traction. I wasn't even aware of it at the time. The best way to protect yourself from monetary debasement pre-Bitcoin was gold and silver miners. So I became very expert in picking those companies. I worked with a bunch of guys in the industry. I put some money with them and learned from them. And ever since that time, I've stuck with the same theme. I actually thought 2008 might lead to kind of the end of fiat, and that the bursting of that credit bubble and what they did in terms of the money they printed was going to be fatal to fiat. I was obviously quite wrong about that. They got another cycle going, and they took rates to zero for a long time, and they were able to create a larger bubble. The Fed has been great at creating these bubbles, right? They created the dot-com bubble, then they created the housing bubble, and now they've created the everything bubble, as we all refer to it. So, what my fund does is the fund is designed to protect the people who invest in it from monetary debasement, which I think is as close to a certainty in life as anything. Nothing's a certainty. People have asked me, say, well, what would make your fund not do well? Well, if the government got really responsible and balanced its budget and cut back and back them, had a positive real interest rate and backed the money with something sound, that wouldn't be good for what I'm doing. But I say those things and most people kind of laugh, like the odds of that aren't very high, right? So the fund is designed to protect from monetary debasement. And then, as I'm sure your listeners and you will be interested in, along the way, I kind of got orange pilled. Right, I was vaguely aware of Bitcoin in the 2010, 11 area, but you had to go to a cafe and use a paper wallet, and I mean it was really primitive, and so that was too early for me. I knew some friends who did it. I didn't do it. I was filling out the forms for Mt. Gox's account, and they failed. Thank goodness, or I would have lost some money there. But as you recall, right after Mt. Gox, Coinbase came along, and so that's when I bought my first Bitcoin out of Coinbase, and didn't really fully understand it, but just every year kind of learned more. Bought right into the peak in 2017. I paid 17,000, and of course I bought it before that. I bought it all the way up, and then it went down. I bought more, and I kept. The more I learned about it, the more comfortable I got. I was always worried about the technology. I mean, guys my age look at computers and think, hey, computers are unstable, particularly in the early days of the PC. I mean, the IBM. Most of you guys probably won't know this, but IBM used to do a thing. The PC used to do a thing called go blue screen. You'd just be working at your computer and suddenly the screen would turn blue and everything you were working on was lost and you had to reboot and start wherever the last set of files were. So, I thought to myself, hey, money based on a computer, how's that going to work? What happens when the computer goes blue screen? And of course, it took me a while to understand what a blockchain was and what hashing was and the way it was cumulatively built and the cryptography that made it secure and the nodes that validated it and so on and so forth. So as I worked my way through those problems and I got more and more comfortable with the technical issues, that created a sound form of money, immutable digital money, I got more and more comfortable and became more and more orange pilled. And I now believe that Bitcoin really is digital gold, and it will ultimately flip gold. But unlike a lot of the hardcore Bitcoiners, including Saylor, who kind of think it's going to happen tomorrow, my view is that there's a process in place here, and there's still a role for gold and silver as sound money. I call them analog sound money. I call Bitcoin digital sound money. And, the analog sound money is not going to go up as fast as Bitcoin, but it doesn't have as big a drawdowns either. It's more stable. The largest gold drawdown that I can recall was in the high 20% in 1 year. So, and as we all know, Bitcoin's had some very substantial drawdowns as it's getting adopted. So, the fund I manage, my investors can't have me reporting I'm down 70% for the year. So I can't be 100% Bitcoin, but we have 15% Bitcoin, 85% silver and gold miners. So that's kind of what I'm doing. And I think this is I think the sound money movement is a very important cultural and social movement above and beyond just number go up and making money and protecting what you've saved. I think a lot of what's broken in the world today is a function of fiat money and unsound money. And I think, you have unsound money, you have unsound ethics, it just creates fraud everywhere, as we've just seen with FTX. And so I believe that if we want to fix the world, my byline is fix the money, fix the world. And we've got to go back to a sound money standard if we want to return society to a more sensible society. So I think that's kind of the best introduction I could give.
It's a fantastic introduction, and we tend to agree here at the Bitcoin Layer. Myself and Nick, we tend to feel that these central bank distortions, this ability to essentially warp price signals at will in order to influence the very vague aggregate demand, which economists love to throw around as the main driver for an economy. Every distortion that you see is a derivative of that, and so
absolutely
I agree that a return to sound money is something that's extremely important. One question I've got for you: you're in the monetary metals, and you're also in Bitcoin, and so for you, you see the crossover. You see the crossover as monetary debasement insurance. How do you square away people who are monetary metal investors and haven't gotten into Bitcoin yet? How do you liken Bitcoin to monetary metals? And you mentioned that there was sort of a hurdle that you had to go over in understanding Bitcoin.
Right.
Some of your associates that you've worked with, how do you go about explaining Bitcoin to them?
Yeah, it's a great question. And as some people on Twitter said, hey, you get it from both sides, because the hardcore Bitcoiners, criticize you for having this boomer rock, and the hardcore gold guys criticize you for crypto, and frankly a lot of crypto is bullshit, as we just have seen. The only crypto that's not bullshit is Bitcoin. But it's the way I try and deal with it, Joe, is I start off by explaining that what is money. And I think Breedlove's done a great job with this with his series. Money it's a couple things. It can be tangible. Gold is a tangible form of money, but it doesn't need to be. And in fact, we've really moved to a ledger-based society. And even before mankind, had gold as kind of the supreme form of sound money, people were keeping score. There are caves with markings on the wall, and people were counting and saying, all right, I killed 3 deer, you owe me 2, and so on and so forth. So money is really just a ledger of who owes who what, right? And historically, you couldn't trust the government to keep an honest ledger because they keep printing more. So you went to gold because you couldn't print gold, right? And so pre-Bitcoin, that's the world as we knew it, with a lot of distortion in the gold price, but that's a different matter. And Bitcoin comes along, and to me, I'm sure you agree that the incredible innovation of Bitcoin was the ability to create provable digital scarcity. Before it existed, you didn't have it, and now that it exists, you do have it. It's like, think before the printing press, you had to write out manuscripts in the Bible by hand. Once you had the printing press, you could make multiple copies really quickly. It's that kind of it's a breakthrough innovation, proven immutable digital scarcity. And so I try to emphasize that to gold holders and say, hey, we've got digital gold. This is it. There are 21 million of them. It's verifiable, period, full stop. Now, in the defense of some of the gold holders, they look around and they see, a lot of the signs around the area. And when I say the area, I mean not just Bitcoin, but I go to crypto, send all kinds of warning signals into the mind of the average gold investor. The average gold investor is conservative, thoughtful, and doesn't believe in bullshit. And so when you've got people saying, have fun staying poor, and, tweeting every time the new, Bitcoin hit 64,000, Bitcoin hit 65,000. When you've got people pumping the shit out of something, that sends all kinds of warning signals to gold investors, and then you've got 25,000 of these coins, and you've got FTX, and you've got Luna, and so there are a lot of things in the space that unfortunately gave a lot of gold investors the wrong set of clues, and they just looked at those things and said, "Oh, I know what this is. This is bullshit. This is all just bullshit." And what I try to do, and I view my role in this whole revolution, is I'm the gold guy who gets where they're coming from, and yet wants to orange pill them and wants to explain to them why they're right. There's a lot of bullshit in the space, but there's a real signal in the immutable code that is Bitcoin. And that if they miss that signal, they're really going to be missing a great optionality opportunity, because two things are going on here. I mean, one, as money gets debased, and it gets debased more quickly, which I think we're all seeing happen, all forms of sound money are going to increase in value relative to fiat. That's happening, will continue to happen. However, in the Bitcoin case, you've also got an adoption curve. There are 8 billion people, there are 21 million coins. You got less than 10% of the people in the world using it. And so there's going to be demand for it as we move in that direction. All more and more gold holders will want to hold Bitcoin. More and more people in the world will want to hold Bitcoin. The third world will want to hold Bitcoin, et cetera, et cetera. So the adoption curve really suggests that, the price of Bitcoin is going to go up a lot in the next 10 or 15 years. Multiples of where it is today. And so for that reason, I try to convince gold holders that, okay, I get that you're skeptical. I get you're worried about the technology. I was too. But the right answer to how much Bitcoin you own, the only wrong answer is zero. In other words, you have to have some allocation in the space. And as we all know who've been in the space for a while, once you get a little bit of an allocation, then you get interested, then you read more, you learn more, then you start thinking, gee, you know what, my allocation is too light. I need more of this. It's better than the other things. And so I try to get people to get off of zero and to read the white paper and to understand what this thing really is and what it can and is likely to be, and therefore to start buying it. Then I often encounter two other arguments, and one of them is, okay, it's really, really volatile. Absolutely, no question. You don't buy it when the Meyer multiple is 5. You buy it when the Meyer multiple is under, the 200-day moving average. And you dollar cost average it because it is a volatile asset. And so you buy it on a consistent basis, recognizing that if the price goes down, that's a buying opportunity. So the other thing people counter with is, well, the government's going to come and take it away. It's too good to be true. The government will come get it. And I think in that case, I try and counter with, well, yes, they would like to, but I don't think they can. If you've got 12 words, the BIP39 standard is going to ensure that you've always got control of your addresses. And, I suppose at gunpoint, they could make you tell them your addresses, but you could choose not to. And it's going to be pretty hard to take away. There are going to be a lot of boating accidents, just like there were in the gold space. So that's kind of the sales pitch I use to the gold people. And I ask Bitcoiners to try and be understanding of the gold people, because they've got half the problem right. They understand the debasement issue cold. They're Austrians. They always have been. From my point of view, I love the fact that Safe came along and wrote his book, and that I'm talking to guys like yourself in their 20s and 30s. We're quoting Austrian economics. That didn't happen in the 80s and 90s and 2000s. I was pretty lonely as a gold bug, and now I've got reinforcements, so it's great.
Indeed, Twitter is great that way. You can sort of curate individuals like that, and you play an important role, Lawrence, bridging that gap. And I want to expand on one thing that you mentioned, in that gold and Bitcoiners, they come from sort of the same ethos. Gold bugs and Bitcoin advocates of myself and other individuals like me on Twitter, and people my age. We all are Austrian economics. We've all got a healthy level of skepticism and adversarial thinking, and those similarities between gold bugs and Bitcoiners hold true. But the difference is that you pointed out, Bitcoin is in the process of monetizing. And so you regularly see minus 15% in a day, minus 30% in a day.
Absolutely.
And so because of that, you see those sort of price swings. Gold bugs look at that and the alarm bells go off. And that's natural because they have a healthy level of skepticism. But it's because Bitcoin is in the process of monetizing. It has a substantially lower liquidity profile in gold. that's why you see those volatile swings.
Exactly right. That's the exact explanation. That and then you add in all the leverage. I mean, I think the thing that, you asked something, what have you seen in the last few years that have changed your view on this? I mean, the thing that has shocked me, and that I think we've all been awakened to, and Caitlin was always warning me about it, but I didn't fully understand it, was just how leveraged this entire area was, right? I mean, it was just people were borrowing on borrowing on borrowing. I mean, look at FTX, look at Luna, look at all these. I mean, it was all just paper, and it was kind of the fiat. I mean, the crypto space sadly took all the worst of the fiat games and let it run wild, and I've always maintained, I'm sure you agree, that you've got to own your Bitcoin without any leverage in cold storage, not on an exchange. I mean, it's pretty simple. But sadly, I've seen a lot of people lose sight of that truth. And there were stories. I mean, I remember when Plan B came around and said, Bitcoin's going to be at 150,000 in the summer. And I know guys who had a couple of coins who levered the shit out of them. And then we had a drawdown and bang, their coins were gone. And it's sad, right? I mean, and I guess I'm helped by the fact that I was buying at 17,000 in Thanksgiving of 2017. It went to 10,000 the following year. I doubled down. It went to 3,500 the following year. And I have to say, when I bought at 3,500, I thought, I might be throwing this money away. I just don't know. This thing has really come down a great bit. But it seems to me like it's a sound idea. And we haven't gone through the block wars and all that stuff yet. It seems to me like it's a sound idea. And hell, if I paid 17 grand for some, I sure as hell ought to be buying at 3,500. I mean, I know enough about investing to realize that dollar cost averaging, unless I thought it was going to zero, and I didn't. And so I doubled down at 3,500, and that's kind of how I feel right now. I mean, 1,700 is a gift, or 17,000 is a gift. I mean, you could have paid 68,000 for this thing not that long ago, and people say, "Oh, I missed it." No, you didn't. Well, okay, well then it's going to die. Well, no, it's been through this before. Go look at the charts, and we know that this is the cycle, right? The good thing is, and I think this is important. I saw a study that showed very clearly that as volatile as it is, I think the volatility is going down. I mean, just barely, but it's trending down. I think that will continue to occur as it gets more and more widely distributed, and as more and more institutions come in. I mean, yeah. So
yeah. So its correlation is strengthening with the S&P 500 actually, and the Nasdaq and other sort of high beta risk on components over time. And I think that's just going to be a function of more money managers and people who have all this capital treating it that way. But I think through time, as it begins to approach the liquidity profile of something like gold, and more as the central bank becomes the buyer of last resort of government bonds and distressed public assets, and it lowers interest rates once again to well below inflation, then I think people, after Bitcoin has this, 10 trillion, 20 trillion liquidity profile, people are going to start viewing it as debasement insurance, as you do.
Absolutely. No, it's funny. I mean, I saw a good tweet that said, ultimately, in the long run, Bitcoin is like the most risk-off thing you can possibly do. I mean, it really, there are only 21 million of them. And, I mean, that's the other thing. It's one Bitcoin is one Bitcoin. It's the fiat price that's bouncing around a lot. What I mean? And ultimately, we will be on in my belief, we will be on a SAT standard. And, it'll be, how many sats is this going to cost me? And we'll work for sats and we'll spend in sats. But obviously we're a long way from that. This will, it was 14 years to get to what seems like a Gladwell tipping point at about 10% right now, adoption roughly in the Western world. And so that suggests it'd be another 14 years till we get to 19%. Could be a bit longer even. I don't know. This is tricky. I mean, I've got a lot of boomer clients, and people are afraid. And the big thing of the past year, obviously, has been get your coins off the exchanges, and I've done it for some time now. But they're not comfortable with that. I mean, to get them to buy a Trezor and to get the 12 words and to wipe it out, and I mean, it's not hard to do. You know that, I know that, Bitcoiners know it. But it's, they want to be able to, they want to have somebody they can call. They want to have some institution that holds the money. They want to have somebody they can rely on. They want to, they're prepared to give away their sovereignty for what they consider to be, a fail-safe, and as we all know, it's not a fail-safe, but, it takes a change. But again, even with those people, I see the process unfolding. Do you know what I mean? I see them buying a treasure. I see them starting it up. I say, okay, send a tenth of a coin, wipe it out, do it again, wipe it out. Okay, you get it? If you got the 12 words, you got the coins. Go to Bitref, put your address in. Oh, you can see your coins. They're there. That's a good thing. I was around when the internet came in, and sorry about that. I was around when the internet came in, and that was annoying too. It was a pain in the ass. I mean, you were probably pretty young when it happened, but we had these dial-up modems that made all these sounds, and you get dropped, and it was a pain in the ass. And then you get a green screen, and you didn't even have a browser or anything. It was pretty damn primitive, but it improved, and same thing's happening here. And this reminds me very much of the internet, network effect, etc.
Absolutely. When these technologies, these innovations are in their morning years of life, therein lies the friction, right? In the
Right.
case of, the internet, AOL, booting that thing up.
Exactly. It was horrible.
And then, with Bitcoin, obviously, learning how to take custody, but also with Bitcoin, that's when the aha moment occurs. And you mentioned the word verifiable earlier, and that's Bitcoin's innovation. It's verifiable
Right.
digital ownership. Whereas and you have both paper gold and paper Bitcoin. And
Absolutely. It's a huge problem. Yeah. Triple entry accounting is another word I should have said. I mean, it's the introduction of triple entry accounting.
It's truly remarkable. It is. And
Yeah.
with gold, you've seen manipulation of the price, sort of
Oh, yeah. Oh, it's horrible.
absorbing the buy side with paper gold.
Absolutely.
And then with Bitcoin, you've seen the same thing too. With FTX, it turns out their balance sheet leaked. They only had, at least in one of their entities, it could have had separate balance sheets, but they had 1.11 Bitcoin.
Right.
Versus,
I think weren't they short 66,000 or something, like $1.5 billion worth?
something to that tune. So they were, they had their customers' order book. They were essentially telling their customers that they owned Bitcoin. Meanwhile, they were taking in, that capital and then actually just playing around with it, taking out short positions on this and that. And it turns out that they had a net short position of several thousand Bitcoin at the end of the day when it all went bust.
Yeah. Yeah. No, and that is a problem. I mean, people say, well, Bitcoin is completely incorruptible. Well, yes and no. I mean, it's better. You can see the chain, you can see all the movements, you know who's got the real coins, and you can verify them by making somebody prove they've got control of an address. But there is paper Bitcoin. It's not nearly as much in size or scope as paper gold. They've had 50 years to build up the paper gold market. It's quite sophisticated. A lot of evidence supporting that. But the Bitcoin area, there hasn't been nearly as much paper, but it's not immune to it. I mean, I think that governmentally, when we break the system down and reset a new system, which I think is what will the challenge of this fourth turning in your generation, I think one of the very important laws to be created will be to totally ban financial derivatives. With the exception of physically, I mean, a futures market in physical wheat, grain, corn, oil, whatever, where you can actually take delivery of the commodity. That's a necessary thing. I mean, producers and users need that futures market. The problem is when you go beyond that and you start letting people, gamble above and beyond the underlying need related to the commodity, you've basically said, we're going to let this thing be a casino and the people with the biggest balance sheet can win. And the governments always have the biggest balance sheet, so the governments can manipulate all these prices, for their own ends. And that's what they've done. And that's how they've managed to have so much inflation without the gold price reflecting it. And why, as Bitcoiners point out, and they're right, gold has failed. Not entirely, because it has gone up 8% a year since 1971. But in terms of really capturing the monetary debasement, it's ridiculous. I mean, I've said this before. Gold, using the 70s math, the 60s and 70s math, gold should be at $80,000 an ounce right now. And it's at 1,700. That's how much manipulation there's been. It's a lot.
Indeed. Severely underpriced, severely underestimating the government debt problem. And derivatives are a huge issue. I think I was taking a look at the top 25 banks, and they have derivatives in, I believe, 25 times excess of the actual assets that they hold. And we're talking JP Morgan, all the big hitters. And what you should be, there should be physical hedges where you actually take delivery. But that has burgeoned and grown off into this, this horrible growth where now derivatives you know, are several hundred trillion, I believe, approaching quadrillion. Whereas, you know, it's several orders of magnitude larger than the amount of assets that we have.
Right. And what you're alluding to and what I can see coming is if some of these things start to blow up and go the wrong way, you know, you're going to have a complete collapse that's going to involve the printing of trillions and trillions of dollars. And then eventually the people in the world lose confidence in the ability of the government. I mean, the dollar has value because it's theoretically scarce. I mean, it's not incredibly scarce because they've grown the outstanding dollar balance consistently for, you know, 100 plus years, but it's theoretically scarce. But once that scarcity disappears, as you know, Gresham's law kicks in, and people are going to say, all right, I prefer to have a form of money that can't be printed. And, you know, the three natural things that come to mind are gold, silver, and Bitcoin. I mean, oil in a sense too, but oil is actually a commodity that gets used. So it's hard to use a commodity that's used as your source of money because it doesn't stay around long enough. But the point is that, yeah, there's a big pyramid here of these things. And it's hard for those of us who are in the sound money community because we've been warning about this for 15 years. And everyone says, well, you're Chicken Little. It hasn't happened yet. And they're right. It hasn't happened yet. But you know, it's accelerating. I mean, you know, Fed balance sheet used to be 800, you know, now it's 9 trillion. You know, with the next one, it'll probably go to 20 trillion, and then it'll go to, you know, I mean, you can kind of see where this is going. I mean, as my pinned Twitter tweet shows that, you know, you can't increase debt, you know, at a rate in excess of the increase in GDP without there eventually being a problem, because the GDP is what generates the income to pay the interest on the debt. And eventually the debt either has to collapse and be worthless, or the GDP has to be massively inflated to catch up with the debt. Pick one. And, you know, we don't, I mean, my bet and my fund's bet is that at the end of the day, governments, you know, in their effort to save themselves, will go with the print to try to keep the system running versus allowing a complete and total collapse like the 1930s.
Which is what they have done several times over.
Exactly. I mean,
at every turn they've chosen.
At every turn, yeah, and every government. I mean, it's, if you look historically, there are very few outright monetary deflationary collapses. There are a few. I mean, the 30s was a pretty good one. You know, they actually held the money relatively sound. I mean, Roosevelt grabbed the gold and devalued it, but the point is that they at least stayed on a semi-gold standard at the time. And you know, the U.S. chose to take the deflation route. You know, Weimar earlier had already hyperinflated, and then France and Russia had extremely high inflation. You know, Britain kind of did a mix of the two, but more on the deflationary side. It's, you know, it's a mess, but what it leaves those of us who are in the investment business doing is trying to figure out the best way to protect oneself from these government policies, which are certainly going in the wrong direction. I mean, forgiving student debt was a big one recently. You know, the interest on the U.S. debt today, I mean, there are charts on the internet or Twitter, $750 billion. I mean, that used to be, as recently as a few years ago, that was in the 300, I think not long before that, in the 200. So just the interest costs of the U.S. debt have gone up almost $500 billion in the last 5 years or so. I mean, that's a big number, right? I mean, the defense budget's $800 billion. So, and that's part of why we know the Fed has to pivot, right? If they do not change that, interest costs are going to become the whole budget. I mean,
yeah, the Fed wants to hold higher for longer, but what they fail to see, and actually I have it up on my screen, the U.S. Treasury maturity wall is in 3 years, massive maturity wall, and the weighted average coupon on the debt that has to get rolled over is going on 2.2, 2.3%, where it's been 0%. And we already have an interest cost that is absolutely skyrocketing. When this debt has to roll over, if the Fed holds higher for longer to that point, the short rates on treasuries, if they don't fall materially, which they are beginning to, it's going to be 2.5%, 3%. And that's not something the government can finance.
Yeah, no, it's right. So they've really kind of painted themselves into a corner, and it's sad. I mean, I guess this is what happens in democracies, right? You just, you know, you try to make everybody happy, and you kind of ignore the, you know, the long-term consequences. I mean, it's one of the great evils of Keynesianism. I mean, I think for Keynes to say in the long run we're all dead, I mean, that's a really nihilistic, you know, philosophy. That's like saying I'm going to screw my kids, you know, just fuck them. I mean, I'm going to live now and eat all the seed corn, and they'll starve. I mean, in the long run, we're all dead is an evil thought process. It really is. I mean, the bottom line is, we are all conservators of this earth, and we're here for a brief period of time. We have to hand it on to our kids and the next set of people, and we're supposed to do the honest thing, which is to pay as we go. But that's not Keynesianism. Keynesianism is, let's have growth at any cost, and we'll worry about the consequences later. There actually is a free lunch, which is a lie. There is no free lunch. And for money, money has to be fairly priced to create productivity. I mean, the error in Keynesianism is they think they want to have growth at all costs. And, unlimited growth in a fixed resources planet, it's insane. It's absolutely insane. It's the stupidest thing I've ever heard of. I mean, the planet is fixed in its size and resources. Well, we don't want unlimited growth. What we want is unlimited productivity growth. We want to be able to get more with less. That's the key, right? And the way you get unlimited productivity growth is you make good investments that drive productivity, higher productivity. And the way you know what those good investments are is you have everything priced properly. And so the price signals, I mean, the reason capitalism works is that the price signals tell everybody, this is what I should be doing because I'll be rewarded for doing it. And the problem is when you've got the price signals driven by this elastic currency, you get everything just goes berserk and you get these wide swings. I mean, go look at a chart of lumber. I mean, imagine being in the lumber business the last 6 years. I mean, it's been like these incredible swings of, straight up, straight down, straight up, straight down. How can anybody plan in that kind of environment? And it's all because the money is broken. We've got to fix the money. The money needs to be sound, and then we won't all be suffering so much. I mean, if you look at the technology that's occurred since I got into the business world, I mean, all the computers, all the, internet, everything that's occurred, we all should be working 30-hour work weeks and having a much higher standard of living than our parents did. And yet, in fact, we're working longer weeks and having a hard time keeping up. And arguably, my parents had a higher standard of living than I did. They could live very well on one income, and they could save and so on and so forth. And that's all because of the broken money. That we've, and it's incredible that we've done as well as we have, given that the money is broken.
Absolutely. And through time with, these technologies that have proliferated, that have been deflationary. I mean, taking a look at what I have in front of me, I have a laptop computer that's plugged in, that's projecting out to two 1080p monitors, which wasn't even a resolution 20 years ago, 30 years ago. It wasn't
right, exactly.
And so this should, right, the technology I have in front of me, I have a supercomputer that sits in my pocket. My standard of living should be orders of magnitude higher than my grandparents, my great-grandparents.
Exactly.
But as a function of the Fed and the United States government choosing, as a function of Keynesianism, and perhaps the 4-year election cycle, which does incentivize growth at all costs, even if it means a marginally lower standard of living. As a result of that, living standards have fallen. So let's jump off of that, and let's move into what the Fed is preparing to do. So we've talked about how at every single turn, the Fed has decided, okay, so you have two choices, right? You can either be austere, right, and actually you have a decade of growth to productivity to come up and meet the debt problems. So you can actually pay interest on that debt, or you choose to monetize it. And through time, the Fed has chosen to monetize not only government debt, but also distressed public assets like we saw in 2008. Yep. And every single time, so what the Fed has done is they've created bank reserves used to be such a minute aspect of the financial system, right? But now they represent $3 trillion worth of assets on bank balance sheets. We don't even know what happens when these things go, the way of the dodo. We don't know what happens when these things get off banks' balance sheets. But now we're removing them from banks' balance sheets more aggressively than we ever have before. As we're doing that and sucking liquidity from the system, at the same time that in 2 hours from now, we're about to see the FOMC deliver yet another rate hike, this time 50 basis points. This year has seen extremely, extremely aggressive liquidity contraction. So moving into 2023, what do you think the economy and the market looks like? What do you think growth looks like? What's your outlook moving into 2023? as this much higher cost of capital gets digested by businesses and individuals?
Yeah, so I don't have a crystal ball, but I'll just give you my best, my spitball guesses, right? And that's really all they are. There's a lag between the Fed actions and the problems surfacing, and we're starting to see the problems, the liquidity problems surface. I mean, Blackstone gating their real estate fund, and then Starwood following suit and doing the same thing. England and the liquidity-driven investment thing. I mean, England decides to cut taxes and increase spending. The pound goes straight into the tank. The interest rates go straight up. LDI blows up. And they say, oh no, we're going to back off of that. So you're seeing cracks in the system. I mean, Larian said it really well, I think, when he said, the Fed has absolutely slammed on the brakes, the tightest rate hiking cycle ever. And they were way too loose before that. And the effect of that is that the economy is going through the windshield, and so I kind of liken this. It reminds me a lot of 2007 when my hair was on fire, that, the housing market was a bubble. And in the summer of that year, the two Bear Stearns funds, their real estate funds blew up. And, that was kind of the first clue that the problem was going to surface. But if you recall, that's, say, July of 27, we didn't have the Lehman moment and the complete crisis until the fall, say September, October of 08. And so if you consider that the Fed started hiking in February this year and got very aggressive about it this summer, I mean, I would think that it's possible. I mean, I'm pretty sure that we're going to see something pretty dramatic in 2023 in terms of, both the economy, the money markets, the stock market, all of it. I mean, I think something's going to break. Okay. They think they can engineer a soft landing. Perhaps they can. I don't think it's not entirely impossible, but that's what they're trying to talk us into. And I don't think it's likely. I mean, you look at the car sales, you look at the housing sales, it just takes time. You look at the higher interest rates. I mean, everybody had a floating rate loan, is paying higher on that. You look at savings, how quickly they've gone down. You look at how consumer credit has gone up. I mean, people are kind of maintaining their lifestyle by borrowing. You can do that for a while. But, credit card interest rates now, I never carry a balance, so I don't know. But I hear that they're like in the 20s, that it's hard to get a credit card with a revolving line that's less than 20%. I got to tell you, that's debt slavery. That's like the mob, usury. So I think people are going to be getting squeezed. I think the economy is going to be feeling it. And to me, it's only a matter of time before the Fed, and we already saw this in the last meeting minutes. You could see it. You alluded to it pre the show. They're starting to have debates in there like, hang on a second, we're going to kill this economy if we continue this. And so to me, the market's already starting to price in a pivot. And that's why actually, I think Bitcoin has bounced up a bit off its lows, and gold and silver, the charts are starting to look very good. I think it's because the sound money market, or sound money assets, can smell in advance what the Fed is going to be forced by the markets to do next year. And whether it's a soft pivot or a hard pivot, who knows? I don't know if something really breaks. I could certainly see something breaking, though. I mean, the stock market actually, to me, is pretty dangerous. We're only down about 20%. And, I think there's a lot of hopium going on. People say, well, there's still the consensus estimates for S&P 500 earnings next year are still like up 7%. I'm like, really? How is that? I mean, I don't see. I mean, I think, and they're pricing off a pretty high multiple of that. So higher interest rates means you should have multiple contraction by definition, because you can now get 4% in a 1-year Treasury, and then you take the earnings number down because you've had wage inflation. That's the other thing that's going on. I mean, wage inflation is kind of locked in at 6%. The airline pilots just got a lot more than that. So I don't think inflation's coming down, but I don't think it's coming down as fast as the Fed would like. But I think that what's going to happen is, just like Powell said, well, inflation's transitory, and he was wrong. And then he said, well, we're going to raise rates until we get inflation down to 2%. And that's our primary focus. I think that's his primary focus until Congress, the president, the country is squawking that, hey, you're killing business and everybody's losing their job, and then they're going to say, well, maybe we need a slightly higher target, and we project inflation is going to continue to come down so we can soften up again. And then we're going to be, the monetary metals and Bitcoin are going to take off like scalded dogs, because, everyone's going to realize, I mean, what needs to happen here, Joe, in my opinion, for our stuff to really work well, is everybody's got to realize how trapped the government is and how all roads point to more monetary creation. And they do. And the only issue is at what time frame and what time scale, right? We don't know that with certainty, but we know that that's where all roads point. I mean, I think the notion that he's going to literally drive us into the depression, I don't buy it. I mean, I think he's going to, I think today he might talk tough, and I think that might take away yesterday's rally in the stock market. But, the notion that, I mean, they're political animals, and when the country is screaming about, the potential depression, recession, job losses, et cetera, versus screaming about inflation. I mean, gasoline prices have been relatively calm here for a while. They'll pivot and print more money. And on that next pivot, gold will go through 2,000, silver will go through 30, Bitcoin will go through 25,000, and we'll be off to the monetary races again. And the economy will hold together as a result of that. But we will have inflation. I mean, gold eventually, or oil eventually, is going to go back into the 150 range, and gasoline prices are going to start going up, and then inflation will become the issue again. And they're trapped. I mean, the problem is they're really trapped. That's the bottom line. But it's very difficult to know how they're going to steer this car. I mean, they stayed way too loose for way too long post-COVID. And then, of course, they pivoted, then they went incredibly hard. Now we're headed to complete depression if they continue this policy. And,
I think Peter St. Onge put it best. He tweeted yesterday, the Fed slams on the gas, then they slam on the brakes, then they slam on the gas again.
That's right. I mean, and that what this all shows you is just the stupidity of central planning and of trying to set a price through government diktat. I mean, the interest rate ought to be the free market price that balances the supply of savings with the demand for investment, returns. That's what the interest rate ought to be in classical economics. We are so far away from that, and the system is so broken and out of control. And maybe they can steer us back to that. I hope they can. I mean, I don't want to see the economy of the country fall apart, but I'm skeptical that they can steer us back to that. And to be honest with you, the seeds of all these problems right now, and we haven't talked about this, they were really sown. The great crime here, I mean, COVID was a horrible thing, obviously, but the great crime here really was 29 to 2015. Bernanke held interest rates at zero interest rate policy, okay, for 6 years, right? That's what did this. That's what created the monetary excesses and the bubble and the wildness that we're now suffering through. And I mean, it was a crime. It was an absolute crime. I mean, 0% interest rate money, it means the money is worthless. It's a tautology. I mean, if you can't earn any interest on your money has no value, which is kind of true. The money does have no value. So that's what set all this up. And the problem is everyone's trying to think, well, how do we get here? What do we do wrong? How do we fix it? And it's kind of like, sorry, there's no easy fix. We broke it a long time ago. You made these choices to print all this money. The only way out is to default or to inflate or to start over again with a sound money system, which is kind of what, Bitcoiners and gold people are rooting for, that the thing unwinds and then we start afresh. And, that's all part of the fourth turning, and that's part of, your generation. It's going to be a very difficult, traumatic process, but that's part of why I'm fighting the fight in this area, because I think if we get through this, I can see a world that's much better on the other side if we don't get into a big war. I mean, all the people are still alive, all the technology is still there, all the resources are there. What we got going on is we've got a very broken system that does not work correctly, and it's making us all poorer. And so what we need to do is we need to redesign a very fixed system, which would start with sound money. And the unfortunate thing is that, there aren't 5% of the people in this country that understand that that's the issue. They're all fighting over something else.
Because all they clamor for from their politicians is, I'd like you to spend here. No, I'd like you to spend here. Spend on war.
Or
spend on me.
Or you're blue and that's bad, or you're red and that's bad.
And ultimately, where does the money come from? It's created out of thin air.
It's created out of thin air. And that's the fundamental problem. But having said that, if we have the kind of inflation and or monetary collapse that we're talking about, guess what? 100% of the country is going to understand what the issue is, right? I mean, and nobody's wishing for the pain that would create. But, ironically, that pain is what is probably necessary to create, the fix that when we get to the other side will be much better, right? I mean, that's kind of that's what I'm in this for.
Of course.
I don't want to see anything bad happen to anybody, but I do want to see the system get fixed, right?
Me as well. We haven't seen what pain looks like the way you say it, because for as long as I've been cognizant, since just before 2008, the Fed has just immediately responded by
Absolutely.
buying distressed assets. In 2019, it was the day of or 2 days after, when there was a
Yep.
cash shortage in the money market,
Yep.
Fed decided, instead of allowing the bad parts of
Yeah.
money markets, risk markets, what have you, wither away and the economy to pay the consequences,
Yeah.
the Fed has chosen to buy it. And because they've chosen
Yeah,
to buy it, now we're stuck.
it's so ironic. I mean, I feel like a fossil because anybody who hasn't been in the markets for a while, I mean, if you got into the stock market after 2008, all you've known is a bull market. That's all you've known. Buy the dip. And I saw a guy on Twitter this morning. He was talking about how he's going to sell his house to buy Tesla. I was kind of like, dude, that's a very bad idea.
They've still got a price to earnings ratio of like 30 or 40.
It's insane. It's absolutely insane, irrespective of the merits. I mean, it just, but that's how deeply ingrained the whole buy the dip mentality is, because it's worked so well. And it's worked well because in a 0% interest rate inflated, economy, it was a one-way trade. But, nature has a way of correcting one-way trades eventually. It takes some time. Obviously, I lost some money shorting Tesla at various points in time. But, the markets are in the process of correcting, will continue to correct. I don't think there's any doubt that the everything bubble has burst. And typically when a bubble bursts, you kind of go back to the base layer of where it started. And, the stock market down 15%, that's not going back to the base layer where it started. I mean, this market was incredible. I mean, it did multiples from 2009 to today. So we got a long way to go in the process of resetting the values in the marketplace. And in turn, I think as people come to realize that the government response will be printing money, we've also got a long way to go in terms of, I often quote the facts about the math on this whole thing, and just big picture. There's 450 trillion of financial assets in the world. This is stocks, bonds, and cash. 450 trillion. There's about 5 billion trillion of tradable gold. There's maybe a trillion of tradable gold stocks, and there's maybe 350 billion of Bitcoin right now. So let's call it 6.5 trillion of sound, alternatives. So 450 trillion is denominated in fiat stuff, and 6.5 trillion is what I would call stuff you can't print. So what happens when the 450 realizes, oh my God, these guys can never stop printing. Every year I lose money relative to the stuff that can't be printed. Some of it, even if it's only 5 or 10%, is going to say, I need to go from where I am over to there. And so if it were 10% of 450, that'd be 45 trillion chasing 6, and in Bitcoin's case, I mean, Bitcoin will go up more than gold because it's only 350 billion today. So, I mean, how do these things not just have, they're not just multiples higher than they are today? I mean, it's impossible. It's just mathematical. I mean, people say to me, well, Larry, what would change your thesis on Bitcoin? What, I said, okay, it's a great question. If we saw less adoption, less use cases, less people, I mean, if people lost interest in Bitcoin, I would be concerned. But we don't see that. We've got, million addresses with over one coin hitting new all-time records. Addresses with over 0.1 coins, it's hitting all-time records. Lightning transactions, all-time record. I mean, all, the adoption in the third world use cases, incredibly rapid. So, everything points to increased usage of Bitcoin, what I call dogs eating the food, right? And yet there are only 21 million of them. There are 8 billion people. I mean, this is not hard. It's like Foss says, let's keep this shit simple, right? This is not hard. And so, and okay, fine, you're worried about it. You're worried about the technology. You think there's some guys in it who are scummy or promoting, whatever. Fine. How can you have zero? I mean, I've worked on a lot of my friends. Just get something. Just get started. Put 1% in. If you lose 1%, your life's not going to change. If it goes up 10x or 100x, you're going to be glad you had it, right? And that's what I sincerely think that's what's going to happen. it's going to go up 10x sometime in the next probably 2, 3 years or 4 years, and it's going to go up 100x in the next 10 years. So, you know, it's pretty straight. It's pretty straightforward from where I sit.
It's fantastic. So, in positioning yourself for what
Yeah.
is ostensibly going to be just the cycle, the Fed cycle continuing, which is choosing to create more dollars and credit as opposed to austerity, which would be a path out of it. Austerity would be a path out of it, but
Yeah.
it'd be a difficult path. And since
Very
1913, we've never chosen the difficult path. And so
right.
our gold, Bitcoin, other monetary metals, mining stocks, commodities, is this where you want to position yourself if you
That's
believe
that.
that?
That's my belief, obviously, and that's where I put my fund. I mean, look, everybody has to make their own decisions, and everyone's investment profile is different, right? And I would not suggest that anybody, I'm all in on this stuff pretty much. I mean, I've got some cash and some houses, but the rest of my investable assets are here. I generally would like to be an investor in the stock market. When the stock market represents good value, growth, earnings, dividends, etc., I'm there. I'm totally there. I don't see that right now, except maybe in a few commodities companies. I mean, I'm in the stock market basically in gold miners. But yeah, I mean, I feel like every investor needs to have a piece of their portfolio that hedges against the debasement of the currency, because we're at such a vulnerable and risky time with respect to massive debasement of the currency. Yeah, I feel that very strongly. And when people say to me, "What's the minimum?" I say the minimum is 10%, absolute minimum. You got to have 10%. I mean, because I have a lot of friends who are wealthy, done well, and they got a big bond portfolio, they got a big stock portfolio. How much gold do you have? Zero. How much Bitcoin do you have? Zero. I'm kind of like, all right, let me talk to you about that. Let's discuss that, right? Um, and so I try and get them off of zero. And I think they'll be well served if they move off of zero.
That's fantastic. If the bet is perpetual credit expansion, you want to be positioning yourself in a verifiable asset that's
Exactly.
verifiably scarce rather than stocks which will stand to benefit that are still obscenely, obscenely, obscenely overpriced.
Stocks will be better than bonds, by the way. I mean, the Weimar in Weimar, if you own stocks pre-Weimar, they hyperinflated. You still owned the stocks after it was all over. You actually maintained your purchasing power. I mean, I've looked at the analysis of like Siemens, which was a big industrial concern in Germany, but it went up and down a lot in the period of it. But the point is, a stock represents a claim on a business that can earn money in the future. And what we're talking about is a monetary failure and a reset of the money. And so if you own a claim on a stock and you come to the other side of it, and the company they'll operate with the new money, right? And so their value add is their ability to produce something. And so if you own a piece of that, that will protect you. But it'll be extremely volatile during the whole period of transition. And right now, stocks, in my opinion, have not fully corrected the bubble excess that got created from 2009 to 2021. I mean, they went a long, long way, 15% down from the top. We're just getting started, in my opinion.
Absolutely. Well, that feels like the perfect spot to end it. Lawrence,
Okay.
thank you so much for coming on. It's been
Thanks, Joe. It's great to talk to you.
absolutely. We hope to have you on again soon. This is a great conversation. Last thing, where can people find you?
Oh, sure. So as you know, I'm a loudmouth on Twitter. I shit post 24/7 because I react to things that I see. So that's just at Lawrence Lepard, my name online. And then importantly, there's also a lot of free information on my website. I manage a fund. My partner and I, David Foley, manage a fund, and we write a quarterly letter that's widely read. And then we have also research papers and other things. They're all free, and you can sign up for an email list. We won't spam you. At my website, which is Equity Management Associates. The URL for that is EMA, Edward Mark Alpha, the number 2.com. And so you can go there and pick up our research, and it talks a lot about our philosophy and so forth. So we've tried to be pretty transparent about what our fund is doing.
To the viewers, I would highly suggest that if you have Twitter, follow Lawrence on Twitter at the handle. It'll be up on screen and in the show notes. And also sign up for the newsletter. I promise they will not spam you. EMA2.com. Lawrence, thanks again.
Hey, thanks, Joe. Great talking to you.